All right. Well, thank you, everyone. I really appreciate you coming out tonight for our event and coming out to hear us speak about topics that, especially when it's the research guy and the guy in the bow tie, that can be sometimes dry. I need to apologize for the bow tie because one thing I didn't think through was that there's a natural reaction as the research guy, the stats guy, when you hear you're going to speak at an event, you put one of these things on, but you forget that when I go to events and I see a guy with a bow tie, I have a Pavlovian reaction right off the bat. I know I'm going to hear nothing but mind-numbing numbers for half hour to 45 minutes. My jaw goes slack, my eyes glaze over. I'm going to try my best to not do that to you. That being said, my part of the presentation is a little bit data heavy, but I'm going to really focus on big picture stuff. And I want everyone to know that in the next couple of days, we're going to be putting this entire presentation up on our website. So if I gloss over a few things where you want to come back and get some numbers, don't worry, it's going to be available to everybody. And we'll have that up in a couple of days. That being said, let me go ahead and get going here. One thing I do besides being our Director of Retail Research here for Terranomics, I'm also the editor of a publication we do each week called the Retail Newsline. And what I essentially do is I subscribe to the major dailies, the business journals in 45 major cities. I look through all the trade journals from the investment side of things, the retail side of things. Basically, I look through about 300 publications a week, where my goal is just to find the most pertinent retail news that will impact commercial real estate and put together in a format and some analysis that I share with people so you don't have to do all that digging. A lot of you are already subscribers, but I'd like to invite you to sign up if you'd like. Drop me an email. My email is up here, gbrown@terranomics.com. It's a weekly publication. We'd love to share it with you. That being said, our focus tonight is really on the Bay Area and what's going to happen in the retail world ahead in the coming year. We really can't do that without looking at the big picture. And if you look at the big picture, you kind of have to start with a recap. And 2011 was a year where it just didn't seem like we could catch a break. We came into the year last year, and there was a lot of optimism. But right off the bat, the Japanese disaster. Then we find out the first quarter GDP had gone from fourth quarter GDP and third quarter GDP 2010 in the high threes to the low ones. You follow that up with the gas prices that shot out of control last spring, and then of course politics got involved in the debt ceiling debacle, where disagreements went beyond mere discord to actually impacting the economy, and we end up with a self-inflicted crisis of confidence that really sent things sideways for a while over the course of August through about October. Now, we plotted this out on what it did to consumer confidence, and as you see, by the time we got to October, consumer confidence actually reached the lowest level it had been since the meltdown in 2008. But we had a 20-point gain in consumer confidence by November. Coming into this year, it's kind of interesting because it seems like we're maybe reliving a lot of the same stuff we saw last year. But here's a couple of differences. Last year, strong December sales really blew away the marketplace. Think about this. In 2008 and 2009, the Christmas shopping season posted negative numbers. That didn't happen in 2001 in that recession. You have to go back almost 20 years for that to have happened. Going into 2010, most analysts, if you look at what ICSC was predicting or the National Retail Federation, they were expecting sales growth 2.5%. Well, the American consumer showed up in force. 5.1% sales increases. Depending on the site, the source you cite, there's some people that have it up to 5.5. But this set off kind of a tidal wave throughout the industry because suddenly you had Wall Street putting pressure on retailers to get back in the expansion game. And what we saw last year, really up until things kind of went sideways, was retailers across the board were upping their growth plans again. And the interesting thing is if you track national statistics, I know a lot of us are using Reese or CoStar or so forth, and if you just look at vacancy numbers, CoStar, I believe, for shopping center vacancy is reporting something like 10.7% shopping center vacancy right now, and it's only down slightly from, say, 10.8 last year. But that actually reflects occupancy gains of over 16 million square feet. Now, to a landlord, net versus gross doesn't mean much. But keep in mind, Borders and Blockbuster alone returned over 15 million square feet of space to the market last year. Take that out of the mix, we're talking over 31 million square feet of absorption, and certainly there were plenty of smaller retail failures and closures, ranging from Sbarro to Harry and David, but, and the usual day-to-day closures that we deal with in any environment. The fact of the matter is that retail leasing over the course of 2011 actually was pretty strong, and it's the strongest we've seen it in years. That being said, going into this coming year, I see a lot of the same trends that we saw last year. Consumer confidence is on the upswing. Business confidence is up on the upswing. Unemployment has had a couple of good months of declines. And certainly the stock market finally stabilized after the mess that we saw from August and September, particularly where we had those 300-point swings every day. Now, of course, if you look at consumer confidence, the levels that we are seeing this year are not quite what we saw coming into 2011 last year. But again, strong growth. Business confidence, numbers are a little bit lower, but the pattern's up. That's good. Unemployment, probably the most important indicator we can look at right now. The numbers are going down. Now, of course, we all know that there's all sorts of problems with unemployment. There's the participation rate. There are people who drop out, stop looking for work, and we have a serious problem with structural unemployment. However, the numbers are going down, and there has been fairly good job growth as of late. The last couple of months, we've had over 200,000 jobs created. Hopefully that continues. And perhaps one of the better indicators as to where job growth could come from is the Dow Jones is back on the upswing, and the numbers are significantly better than what we saw even heading into last year, even with the malaise that we went through in the fall. Now, the problem is that the challenges are also still out there, and they are still largely the same. Certainly, we've got an election year, political dysfunction is going to be a given. We still have the high structural unemployment. The European debt crisis remains a cloud over the world economy's heads. And my personal bugaboo, gas prices, because I think that's actually the biggest threat to the people in this room and to the retail world. Rising debt, of course, remains an issue as well. But really, I see is if you're looking at the economy in the coming year, what are the biggest challenges? What should we really keep an eye on? It's really up to the Euros right now. Now, the recent Greek debt deal, very positive development. You think about our political issues, the fact that you've got all these member countries that are having to deal with coming up with a plan to avoid a meltdown. It's definitely a challenge. But so far, most of the economists that I track are really on the same page that they don't think that the Europeans will fail when it comes to working out some sort of way to muddle through this. The real problem, though, would be if things do melt down, would be our bank's exposure to the Eurozone, and if there were, say, a Lehman Brothers type of crisis that froze the capital markets again. And that's the real thing to watch for. But again, 3 out of 4 economists, as far as the people I track, are all of the opinion that what's going to happen in Europe is they implement austerity measures. They will have a mild to moderate recession. Now, they're one of our biggest trading partners. It will certainly impact import-export, and it will certainly have some sort of role in being a drag on our economy. But a mild to moderate European recession will probably not spill over into anything major here. Again, back to our political uncertainty. I noticed we forgot Newt, so my apologies to the Newters in the audience. But the fact of the matter is, we're going to have discord this year. I'm actually very optimistic, though, that things will not get out of control like what we saw during the debt ceiling mess. And the fact of the matter is, it being an election year, I don't think either party wants to run the risk of the backlash if they get blamed for something that gets out of control. So I'm a little bit optimistic there. Here's where I have my biggest worries, and that's the gas pricing. For every time gas prices go up 10 cents, $13 billion out of consumers' pockets that they probably would have spent at retail stores generally. If you look at what's happened since mid-December, gas prices have gone up 24 cents a gallon as far as the national average. Each one of those cents, that's 1.3 billion taken out of the pockets of consumers. GasBuddy.com, which actually does a pretty good job of forecasting, is predicting that gas prices will hit $4.15 a gallon by Memorial Day. And with the ongoing strife in the Middle East, the situation with Iran and Israel, those are things we really need to keep an eye on. That is one of the things that could sideline or sidetrack our economy, simply because one of the driving forces that's kept our economy going, if you get away from tech and energy, it's been consumer spending. Now, there are a few other differences as far as coming into this year from last year. Our GDP actually was much better in 2010. 2011, it slumped. We are optimistic that things are going to pick up and get back to 2%, high 2 to 3% growth rate soon. We're also optimistic that job growth is going to pick up. There's a couple of reasons for this besides the recent surge of job creation. We continue to deal with a workplace where worker productivity is maxed out. Corporate profits are still up in the $2 trillion mark that companies are sitting on. Now, of course, we've been saying this for a while. When are the jobs going to be created? I think they're going to slowly be coming back over the course of the year. Anyone who's waiting for a silver bullet or a great big surge, that's not going to happen. But I think a slow crawl, and frankly, at this point, 200,000 jobs a month, slowly creeping up to the 300,000 mark by the end of the year would be fantastic. Even though compared to other recession periods, the recoveries, that is anemic, but this is still a deleveraging recession.